Right, today I'm going to be talking about the outlook for the global steel and raw material markets. There's obviously a lot going on at the moment in terms of global trade patterns and disruption from the loss of the Black Sea exports, but also China as well. Renewed COVID lockdowns there, causing a lot of disruption to their steel production, demand, and of course the raw material flows. So lots to cover today. So China, of course, the big issue is on the COVID lockdowns versus the idea of stimulus. So disruption to the economy. China's economy has been quite weak through the second half of last year. That was predominantly driven by the housing slowdown. New starts fell quite sharply second half of last year, over 20% year on year, after Beijing was clamping down on the property developers. That's had a real impact, of course, on steel demand. Now, to counter the decline in the housing market, Beijing did start to loosen economic policy end of last year. But before that's really had any impact, after Chinese New Year, normally March, April is a strong seasonal time for construction, for infrastructure, for housing, etc. Of course, we've had these renewed COVID outbreaks. At the moment, up to 400 million people reportedly under some form of lockdown, and that is having a clear impact in terms of suspending construction sites, suspending factory activity, and the major impact being on logistics, as people just cannot move materials around so quickly and easily, especially across provinces. So at the moment, yes, China is certainly losing demand. Now, if the lockdowns are able to ease up within a few weeks, hopefully a lot of that pent-up demand will come back and there will feel like a strong acceleration in activity. But of course, the longer the lockdowns last, the more of that demand will actually be lost and won't be able to catch up. Of course, while China's been in this lockdown situation, global steel prices have actually moved sharply higher. We've seen a lot of disruption out of the Black Sea exports in Ukraine and Russia. That's caused much higher prices in Europe and the US, and therefore a lot of demand for Chinese steel exports. But right now, with the lockdowns, those exports are just not able to take place. So the markets are certainly expecting, with a disruption to China's economy, that Beijing will offer more economic support going forward, more stimulus. However, as we've seen with Western world lockdown experience in the last year or two, post-lockdowns, there's generally a lot of issues about catching up to demand and supply chain disruption. And that is one thing Beijing will be very wary about. They may want to stimulate to support growth, but the problem will be, can they execute on more stimulus? That may be very difficult given potential bottlenecks there and an already inflationary environment. So Beijing is treading a fine line between balancing growth, inflation, and unemployment. And so far, as we saw in Western countries last couple of years, Beijing is offering a lot of support to companies to try and alleviate any unemployment problems during lockdown, a lot of deferred taxation, deferred and increased credit for companies to keep paying wages, etc. But still, it's clearly having a bad impact on consumer spending, which was down 3.5% year on year in March. So that is just causing further pain there. So look, Beijing clearly will want to support the economy, but I do see a problem on them executing the housing market, even though we've seen a recovery in sales after the loosening policies at the end of last year. Demand for housing has not come through very strongly for the last 3 years. The message from Beijing has been housing is for living, not for speculating. And even though the speculators now are allowed to buy property again, they seem to be choosing not to, on a belief that prices are not going up anymore. And it's clearly not favored by Beijing for people to be investing in property anymore. So yes, there's still first-time buyers, upgrading demand coming through to help stabilize prices. But from a steel and cement perspective, construction volumes still look like they will be sharply lower this year. One of the key data points there, tracking the construction activity. Komatsu publish information around the utilization of all of their heavy vehicles in China, and that's still sharply lower year on year, showing that even with the accelerating infrastructure spending this year, construction activity does remain lower. That, of course, very bad for steel demand. So outside of a weak housing market, China is also suffering with a very weak corporate sector. Overburdened by debts from the obviously the PPI squeeze. China is not seeing the same CPI inflationary problems at a consumer level that the Western world is seeing, and that's mainly because a lot of Chinese corporates don't have pricing power. So the corporates are just suffering from the higher input costs, not able to pass that on. That's obviously hitting corporate margins, leading to further corporate debt expansion and therefore hampering the willingness of corporates to invest. At the same time, as I mentioned earlier, consumers are not spending. Wage growth is suffering, consumers are not feeling confident, and therefore consumer spending has been suffering as well. So you have a consumer that's not spending, you have a private sector that doesn't want to invest, we have a housing sector that's very negative, and equally we have a situation where China's trade, which has been very strong last couple of years, the export trade catching up to the Western post-COVID situation, that looks like it's fading as well, based on all the lead indicators. So China does have a real growth problem here, which will need further government support. But the problem is that support just doesn't look like it's going to be big enough. And therefore, that will be a drag on Chinese steel demand this year. So yeah, China is certainly building pent-up steel demand while these lockdowns persist. At the same time, we do see that pent-up export demand, higher steel prices in Europe and US, the loss of trade from the Black Sea. That's seen a re-engineering of global steel trade patterns. We're seeing steel, for example, more steel going from India into Europe. That means buyers in Southeast Asia having to turn increasingly back to China. Right now, with the COVID lockdowns, the logistics disruptions, they are struggling to pull more material out of China. Once those restrictions have eased, of course, I expect to see a flood of demand coming in for exports, as well as domestic steel demand recovering quite strongly. So that should be very positive for domestic steel prices. The issue, of course, is will steel mills be able to ramp the production fast enough? Because we know a lot of steel mills during the lockdowns, a lot of logistics difficulties, shipping in met coal and coke, for example, by truck. That's been very difficult, moving between northern provinces in China. So a lot of steel mills, especially areas like Tangshan, have certainly been cutting production due to a lack of coke. And equally for iron ore, domestic iron ore production impacted for the same reason, not being able to move trucks on the road, and imported iron ore, equally moving that to the mills has been a little bit problematic. So we are seeing rising inventory of iron ore at the ports and in shipping queues, queuing up to come into China. But the actual on-ground inventory situations at the mills are quite low. Now that is going to hamper steel mills' ability to raise production out of these COVID lockdowns. So we could see a situation where demand is very strong, mills very much struggling to keep up with that demand, and therefore Chinese steel prices are likely to spike in the way that we have seen in Europe and the US so far this year. So yeah, for China, like I said, the demand situation, the economy, not looking very supportive here. Now, I started the year expecting a -5% decline in Chinese steel consumption this year. That's following a 5.4% decline last year. And increasingly, the risks do look to the downside of that, certainly the longer these lockdowns persist. Outside of China, steel, of course, recovered very strongly last year. Steel demand grew 12% outside of China, taking it 3% above 2019 levels. And with this loss of the Black Sea steel exports, of course, the global steel demand is going to struggle to find enough supply in the short term. So the only solution to that for the year will, of course, be Chinese steel exports. Now, China was a steel exporter on a net basis over 60 million tons in 2019. They were down at 15 million in 2020, bounced back to 40 million last year. So Chinese steel demand, if that's down about 5% this year, that would free up about 50 million tons of steel for China to potentially export. And that would largely offset the losses that the market is seeing from the Black Sea. So ultimately, the Chinese steel exports will be needed by the world. And we see with the price spreads there that it is certainly economic for Chinese exports to start moving, of course, subject to different products, different trade tariffs, etc. We may see China exporting more slab, for example, than HRC. But ultimately, I do expect that trade flow to readjust through the year. In terms of the impact for raw materials, in the steel situation, that pent-up demand, the export demand, that looks like holding for many months. So even if the lockdowns in China persist for a while, I'd still expect Chinese steel prices to be playing catch up to global steel prices through the second quarter, through the summer period. Iron ore, however, certainly has a timing duration aspect to it. Normally, of course, if steel prices are moving sharply higher, as I expect, that's normally a positive for iron ore. Iron ore prices normally move at the same time as mills look to chase iron ore. This time around, of course, the situation is going to be very dependent on how much iron ore is available. Now, if the lockdowns lift quickly, as I said before, mills have very low inventory at the plants. They will be chasing iron ore aggressively, and that could lead to higher prices. The problem will be, of course, if the lockdowns in China persist for a few more weeks or even months, the iron ore imports are still arriving. The ships are still leaving Australia, they're still leaving Brazil, they're on the water, they're heading into China. Now, the port inventory numbers haven't risen too sharply yet, but certainly the port queues are expanding as the ports have slowed their activity during this lockdown period. So, yeah, if the lockdowns in China are lifted in the next couple of weeks, I'd expect iron ore prices to move higher alongside steel. If that doesn't happen, we could be in an unusual situation where steel prices in China do well, ex-China steel prices stay high, but actually iron ore supply could be quite abundant at the ports, and therefore the mills don't chase iron ore so aggressively. Of course, last year there was a big story in iron ore between the grade spreads with all of China's production restrictions. The steel mills were certainly chasing high grade iron ore over low grade. Again, with high steel prices, high steel margins this year, I'd expect those differentials to widen again. The iron ore market outside of that potential inventory backlog in China actually looks very tight, certainly outside of China. We have seaborne supply, which yet again looks like it is going to fail to grow this year, especially with the loss of Ukrainian exports. And the European market, which did get a lot of iron ore by rail from both Ukraine and Russia, is of course having to turn to the seaborne market to try and secure more supply. So the iron ore market itself does look very tight. Iron ore prices, of course, already at very elevated levels historically, $150, $160. But the risks in the short term are that if China comes out of the lockdown quickly, perhaps iron ore could rally back up to $200. If the lockdowns in China persist a bit longer, we probably will have a backlog of supply, and iron ore prices could be sharply lower in the second half of the year. Of course, that tightness in ferrous raw materials does mean it's a very attractive market for scrap as well. We already saw European scrap prices moving very rapidly on the Black Sea steel disruption, and that's certainly feeding through to Asian scrap markets as well. And while seaborne scrap prices are extremely high, again, that means China is not going to be in a position where it can increase scrap imports. So while legally China is now able to increase scrap imports, we saw a very subdued return of China to the ferrous scrap import market last year because seaborne prices were much higher than domestic. And again, at the moment, that import trade just doesn't work either. So the scrap market looks like remaining very tight globally for the foreseeable future. And that means Chinese steel scrap imports will not be happening this year. Medium term, of course, the fact that China is allowed to import scrap again means that the global scrap market is underwritten by that potential trade. That Chinese scrap prices have generally been a lot more stable than seaborne prices. So should seaborne steel prices, scrap prices ease back next year, for example, I would expect China to step in and buy any surpluses, but that looks some way off for now. Also, just taking a second to look at met coal, that's another commodity, of course, seeing extremely high prices. We've seen $500 plus met coal in recent months, again, driven by that Russian supply disruption. So it's not just Europe, Japan and Korea as well, trying to look away from Russian met coal supply, but there's very little alternative supply. Obviously, Australia's had a pretty bad rainy season in the first quarter of this year. That's disrupted their exports. Canada and other countries as well, already very much sold out. So there's limited extra available met coal on the seaborne market, again, which is causing an extremely tight market for the Europeans, for the Japanese and the Koreans, and they're therefore having to pay very high prices to secure cargoes. Now, while the seaborne market looks extremely tight, it's interesting to think about the Chinese domestic market. Now, last year, China was suffering a lot of power shortages, and we saw a lot of met coal diverted into the thermal market. For example, by the second half of last year, Chinese steel production was down 20% year on year, but met coal prices were still extremely elevated. Now, China's certainly solved the power situation by ramping up coal production very strongly. Hydro is also recovering well this year. That means a lot of that switchover tonnage should be coming back to the met coal market in China, alleviating those shortages. So as well as increased domestic supply, China is also seeing more supply coming from Russia for those cargoes that are no longer going to other markets, and also from Mongolia Mongolia was heavily disrupted last year. In Chinese met coal imports from Mongolia dropped to only 16 million tons when we were expecting them to be over 30. This year they do look like recovery. Certainly the trucking volumes are up sharply so far. There is a new rail line that's nearly finished construction that will bring in a lot more met coal from Mongolia to China as well. So China's going to have a rising domestic supply of met coal, rising imports from Mongolia, perhaps 20 million tons or so, and rising imports from Russia, perhaps another 20 million tons or so. So the Chinese met coal market looks extremely well supplied by the time we get to the second half of the year. So there's a possibility there. Could we actually see China exporting met coal again, as it did many years ago? There's certainly, if seaborne prices stay very high, perhaps we can see China exporting met coal into nearby markets like Korea and Japan, while still importing Russian material and Mongolian material at lower prices. And I'll just round off as well on the freight market. Freight rates, certainly this adjustment in global trade, where we're seeing a lot of Russian Black Sea material heading, and Baltic as well, heading into India and China. Meanwhile, Europe not able to buy locally sourced material. It's having to get more material from further afield, like Australia and Asia. That, of course, means a much increased ton miles for the freight market. So freight rates extremely subdued at the moment, especially while China's lockdown is disrupting a lot of orders. But we are seeing rising shipping congestion in China the longer the lockdowns last. And we're seeing globally shipping volumes moving a lot further. So that's certainly very supportive to freight rates. So watch out for those spiking again later in the year once China activity starts to pick up again. That's it for me, and I look forward to discussing further in the Q&A session. Thank you.